Listen to me very carefully, because what I am about to tell you could literally save you tens, or even hundreds, of thousands of dollars in your golden years. So many of you have worked 30, 40, maybe even 45 years. You sacrificed. You did what everybody told you to do. You put money into your 401k, you put money into your traditional IRA, and you watched those balances grow. And in your head, you thought, when I retire, my income is going to drop, so my taxes are going to drop, and I'm going to keep almost everything I've saved. People, I need you to wake up. That is one of the biggest, most dangerous myths in personal finance today. When you retire, Uncle Sam does not suddenly become your best friend. In fact, if you aren't careful, taxes will take a far bigger bite out of your retirement income than they ever did while you were working. And the absolute scariest part? Most people don't realize it until they open up their tax return in April of their first or second year of retirement, and they look at the bill and say, "How on earth did this happen to me?" Let me explain the problem to you, because knowledge is power, and when you know better, you do better. When you were working, you received a paycheck. Taxes were automatically withheld. It was simple. But in retirement, you don't have just one source of income. You have a web of income sources. You might have Social Security. You might have withdrawals from your traditional IRA or 401k. You might have dividends or capital gains from a taxable brokerage account. You might even have a pension or a little side business. Here's what nobody tells you: every single one of those income streams interacts with the others in ways that can trigger tax landmines. Take Social Security, for instance. Millions of retirees think Social Security is tax-free. Wrong. Depending on what the IRS calls your combined income or provisional income, which includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits, up to 85% of your Social Security benefits can be subjected to federal income tax. Think about that. You paid taxes on that money when you earned it decades ago. And now, because you pull an extra few $1,000s out of your traditional IRA to fix a leaky roof or take a dream vacation, you pull yourself over a tax threshold that suddenly makes your Social Security taxable. That single withdrawal didn't just get taxed, it triggered a domino effect that taxed your benefits too. And it gets even worse. Have you heard of IRMAA? Income-related monthly adjustment amount. That is a fancy government term for a Medicare surcharge. If your income crosses certain thresholds, even by one single dollar, the government raises your monthly Medicare Part B and Part D premiums. And they look back 2 years to determine this. So a decision you make today could spike your healthcare costs 2 years from now. Are you kidding me? Then comes the granddaddy of them all, required minimum distributions, or RMDs. For years, you enjoyed tax deductions when you put money into your 401k or traditional IRA. But Uncle Sam wasn't giving you a gift, he was just giving you a loan. And once you hit age 73, he comes knocking on your door demanding his share. The IRS forces you to withdraw a specific percentage of your tax-deferred accounts every single year, whether you need the money or not. If you have built up a healthy retirement account, say $1 million or $2 million, those forced withdrawals can be $50,000, $80,000, or over $100,000 a year. Suddenly, that forced income slams you into a higher tax bracket, jacks up taxes on your Social Security, triggers Medicare surcharges, and burns through your hard-earned wealth. I know what you're feeling right now. You're feeling frustrated, maybe even a little scared. You're asking yourself, "Susie, why did I save all this money if the government is just going to take it away?" Don't you panic. Take a deep breath. You are in control of your financial destiny. Taxes in retirement are a mathematical puzzle, and once you know the rules of the game, you can play to win. So what do we do? What is the actionable takeaway here? First, you must create tax diversity in your retirement portfolio. Do not keep 100% of your nest egg in tax-deferred 401(k)s and traditional IRAs. You need money in 3 buckets: taxable, like individual brokerage accounts; tax-deferred, like traditional IRAs; and tax-free, like Roth IRAs. Why? Because when you have all three buckets, you control your taxable income every single year. If you need $10,000 for an emergency, you don't pull it from your traditional IRA and trigger a tax avalanche. You pull it from your Roth IRA or your cash reserves, where it doesn't add a single dime to your taxable income. Second, if you are in that magical gap between the day you retire and the day you start taking Social Security and RMDs, say between ages 60 and 73, listen to me closely, this is your window of opportunity. This is when your income is naturally at its lowest. Do not sit on your hands. Use those low-income years to execute systematic Roth conversions. Move money from your traditional IRA into a Roth IRA slowly, filling up lower income tax brackets. Yes, you will pay taxes on the converted amount today. But you pay them at a lower tax rate now, so that money grows tax-free forever, comes out tax-free for you, has zero RMD requirements, and passes tax-free to your children. You defuse the tax bomb before it ever has a chance to explode. Third, if you are already 70 and a half or older and you are charitably inclined, use Qualified Charitable Distributions, or QCDs. Instead of taking your RMD, having it count as income, paying tax on it, and then writing a check to charity, you instruct your IRA custodian to send the check directly from your IRA to the qualified charity. That money counts toward your required distribution, but it never touches your taxable income. It lowers your adjusted gross income, protects your Social Security from being taxed, and keeps your Medicare premiums low. That is smart money management. Look at where your money is sitting. Talk to a fee-only fiduciary financial advisor or a qualified CPA who specializes in proactive retirement tax strategies, not just someone who files your return once a year, but someone who builds a plan for the next 10, 20, 30 years. Take control of your money, because when you own your financial plan, you own your freedom. You can do this.